Good morning, ladies and gentlemen. This is Clueless A Trading Frank. Here's a quick pre-market update on 2016 Election Day, November 8th, 2016. And hopefully that each one of you exercise your right to vote. All right. Couple of quick things I want to point out. It's been, to say the least, one of the most chaotic and volatile markets known to in recent memory. But then again, at the same time, we have to keep our heads together and realize that there are certain unquantifiable events, such as what happened on Sunday afternoon at around 3:30, when the FBI declared that that Hillary Clinton would not be indicted or formal charges filed against her after the second spate of emails that were discovered. Whichever the case, we had a violent and powerful rally, and this is what we see right now. Saying all that, we have had multiple winners on individual stocks, Regeneron and Chipotle and Amazon. Weekly calls were tremendous winners, and I'm sure that some of you had it and enjoyed the move up. Saying all that, not to mention the SPX calls, the 2130s, the RUT 1205, 1210s, November 11th, all were alerted last week, and those did tremendously well. What basically blew up are the hedges, and remember, hedges always have to be small. That's why they're called hedges. Are the SPX puts that were put in place, because when we looked at what happened on Friday, you can see that bar here. Keep it real simple. This was Friday's close. You could not imagine that we would have almost a 400-point rally immediately off the bat, but that's just the nature of the beast. Hedges are hedges. Just in case we went down 10, 20 S&P points, that worked out, but they didn't. But the rest of the stuff worked out tremendously well. All right, so saying all that, I'm not going to get into behavioral dynamics and all that stuff. Let me just show you a couple of things that I'm observing so you guys can basically use your own intellect and your own guts to figure out what might be going on. We're going to have a very, very volatile 48 hours. I don't know if the volatility is going to be in the form of 100, 200, 300, 400 points, but you know what? Be ready for it. So at this point, what we see here is this is the weekly chart. We're zooming out here. This is a weekly chart of the S&P 500. All right. So these are a couple of things that come to mind. I've drawn some wide channels. You can see that these two. Then there was this uptrend line that was broken on late October. This one you're talking about. Here are those. This is the Brexit low. And this is the SPX, so the Brexit low was around 1990, 1991. And these were the pivotal lows of 1800s back in January and February of 2016, that many of you might have forgotten. So let's keep the internals aside and take a look at what's going on here. So if we extrapolate out, it looks like, at face value, that the corrective phase in the market, since in between some very, very powerful moves, but the corrective phase in the market that started on 22nd of August and culminated in the lows of last Friday, might simply be a consolidation channel. Remember, these are scenarios that I'm showing to you what I see on my charts. So here's the consolidation channel, right? And it looks like the market was contained within that consolidation channel. I expected the market to basically pull back somewhere around 2060, 2070, but obviously the Comey announcement didn't allow that to happen. The rest of the longs worked out tremendously well. So this consolidation channel, at least for now, is intact. I've explained very clearly that on a Donald Trump win, and it's not me, you guys have read this a zillion times, okay? There would be a knee-jerk reaction, and the key word is knee-jerk reaction, where we would basically come down hard and test the 1990-2000 level. So this pattern would completely be fulfilled. And from this point, we should expect a very powerful bounce that would somehow try to attack the downtrend line, which is still a downtrend line, this red line, at around the 2124 or 2123 level. If we break below that, obviously That's a different story. Then we're looking at the 1800s, which would be a very, very powerful, violent drop in the market, in almost a 2,000 point drop in the market from these levels. All right. So I'm not going there yet because we don't know, but this is possible. If there's a Trump win, we will fall real hard back into this 1990-2000 level, and that's going to be, that should act as a short-term support as the market regains its footing and tries to figure out what's going on. Remember, it's not just about US reaction to markets, but it's also global reaction to markets, because emerging markets don't quite understand the dynamics of US politics, and they are not quite sure exactly what type of cabinet and administration the Trump presidency would have, and that kind of stuff. I've gone over that. I don't want to rehash that. So saying all that, so that's one possibility. Let's get this out and show you the second. So let's assume that this is a consolidation channel. Well, if that's the case, then this bar, which as you can see here is a very powerful, this green bar, yesterday's, is a very powerful bullish, almost a bullish engulfing reversal. It didn't open low and go higher. That would be a bullish engulfing, but this is certainly a bar to contend with. First level of resistance comes in at 2150, right here, 2150, right? And if the downtrend line is broken, pure technicals, the next level of resistance comes in at 2169. That's the upper Darvas. And then we have the upper Bollinger, that's at 2205. I'm not going there yet. All right. So a dogmatic bull, remember, they're dogmatic bulls too. All right. I'm not one of them, but they're dogmatic bulls too. Like the market can only go higher, the market can only higher type of garbage. So if this is a consolidation channel and the market basically moved in between this channel, and if we break out here, then that's going to be the first level of resistance, somewhere between 2170, 2180, attacking the highs. That's at that 2200 level, 2195 level, and then we see. The second scenario is that we hit this powerful downtrend line, which has rejected any of these previous advances since August, right? So we hit this powerful line and we pull back, test the 2070, move up again, 2123, and then we see and then whatever. I don't want to go too far. Either we break out or we fall back towards 2150. It could possibly be, sorry, that we stick within this wide weekly consolidation channel. Now remember, as traders and even investors, we have a very short-sighted, myopic view of things. If things don't work out in an hour, in a day, we think the world's falling apart. That's exactly how your mind thinks. You got to train your mind to think a little bit out. Okay, and you got to look at these daily and weekly charts too to put your trades in a framework of what's going on. Some of the best swing trades can happen in a couple of weeks. We saw that. Chipotle was a week to 10-day trade. Regeneron, of course, was just a hammer reversal. It was a 48-hour trade. But if you want to keep an idea on what markets are doing, you got to look at these weekly charts and keep things in perspective. All right. Now, so number one is that this might be a consolidation channel. The second thing that came to mind is that if this is going to be this bar, this candle has to be respected. Now, does this mean that we're going to basically do a Brexit type of move? And on that, I have to show you the daily. And by the way, here's your 50-week moving average. Here's your 34-week moving average. It was captured yesterday. Here is your level of major support, 2073. And if the breaks loose, if that breaks down, then you have a level of 1990, 1992. These are all on a swing basis, powerful, profitable trades if one understands these things that I'm explaining to you. If you look at the internals on the weekly before I go on the daily, this is certainly positive. We crossed over. Doesn't mean we can't zigzag around. It doesn't mean that we can come down and retest the 1990s and this make a double bottom. But I'm just showing you what's in front of us right now. The histogram shrank very fast yesterday. In one single day, we're only at -13 when we were down to -132, which is a pretty large oversold number, which I'd explained many times before last week. on the McClellan oscillators. Let's take a look at the daily. So on the daily, let me zoom in. Here's your Brexit lows. Here's your uptrend line that was broken, right? That was broken here. And then we tried to get back into the uptrend line several times. False breakouts, all failed. And then we had that 9-day waterfall decline that culminated into a big sudden, I call it a white swan move, right? That's not a black swan, that's a white swan, which decimated billions and billions of dollars worth of shorts by institutional and hedge funds and such who were betting that the market would keep on falling. Okay, it was logical to believe that Monday would be a nervous day and the markets wouldn't make any moves. But then you know what? This teaches you that you gotta be ready to expect the unexpected. So anyway, so this happened. So at this point, there's a couple of similarities that I want to point out, and I'm not saying this is going to happen. These are just probabilities. Remember, there are no certainties. This candle here reminds me of what happened here after Brexit. So is it possible that this was the corrective move to the bottom of the channel and slip below that? And now we're about to get to the upper end of the channel that's around 2150. It's very possible. So if this candle is this is one scenario. If this candle is which was about 26 S&P points, this was 46. Now this was about 30, I think, and this was 46. That's big. So is it possible that and I've showed this in the chart yesterday, that we have a 3-candle move? Is it possible that we have a 3-candle move all the way up to test the 2190 level? Okay. Actually, this is I would say 3-candle move would be this. So take that out. So the 3-candle move would mean that, is it possible that we get up and move up into the zone? Absolutely. Absolutely. So you got to keep that in mind too, that markets have a mind of their own. It's also possible from a bullish perspective that the year-end rally has started. Remember, in general, the markets have a powerful year-end rally during presidential years after the president is nominated. Then you get into elected, and then you get into the tax loss selling and stuff in January, all the uncertainty of the new administration coming in and all that stuff. So if this is the first candle, you'd have a second one, and a third one would bring us to the upper Bollinger or somewhere thereabouts. This is a possibility. Now, in the meantime, let's take a look at the internals. And again, I repeat, you can also simply look at it as a large consolidation phase that started in August. I know it drives us all nuts when we look at things on an hourly, minute by minute, daily basis, but this is what I'm sorry, on an hour basis or an intraday basis, but this is what's really going on. So this is very possible here. Okay. Now, in the meantime, let's take a look at the internals. The internals are looking like, it's certainly positive. If we just keep a robotic eye, this is certainly positive. We crossed over. We're starting, we're actually moving real fast. Another 400-point day will be in pretty heavy-duty overbought territory. No question about it. On the daily, let's take a look at the histograms, which were deep. And I have mentioned this a zillion times that we had those 2130 longs, November 11th. We had a couple of, going out there, which I put out there. You have to have the longs in place because when you get down, and I've said this 100 times and specifically highlighted that on my advanced coaching sessions, which for the benefit of my members, I've actually made free recently because I want everyone to sort of understand what I'm teaching, or not just teaching, what I'm sharing on these years of experience for everyone. I hope some of you are really taking it to heart and benefiting. When you get down past the minus 200 level, okay, regardless of the price function, you start to see a positive divergence taking place. Okay, this is minus 224, minus 225, and I highlighted all this stuff on my charts. 217, 172, right? So the bottom line is, and then we shrank fast. It's only minus 148. Generally speaking, it goes into the positive. So going into the positive can mean a extreme overbought level of 100, in which case the market's a short pretty much, or it can go up to these smaller levels, which is around 14 or 15. The McClellan oscillators are great indicators during extreme inflection points. So the bottom line is that when you get down to minus 200, I basically said you gotta buy with hands down. I'm sure some of you had those longs too. You have to have some longs. Okay, you gotta have a hedge or two. That's not a problem. It's a very uncertain time, but that doesn't mean you have to have a preponderance of longs in order to. Minus 200, you buy. The fastest money is made in the first 24 hours. That's exactly what happened yesterday. Look at the plays on CMG. Look at the plays even on the Priceline earnings call, which I left for others to figure out how they would want to manage the trade. But I was bullish on it. Look what happened to Regeneron. Okay, look what happened to Amazon. The lottos just exploded up 300%. So, and there's a lot of these instances, but I'm not spreading too many stocks out there because it's much easier to manage some of these things instead of having 20 different things out there, 10 different things out there, do whatever you need to do. So at this point, this is where we are. We are within this channel, and if this is a large consolidation channel and we break out over the 50, which is 2148 roughly, 2147, or the 34-day moving average at 2142, you can rest assured that this market will attempt to break out of this large consolidation that it's been stuck in fact, since July. Okay? So you can either break down a sudden event such as a immediate Trump win would break down the market. Otherwise, the market basically will respect this massive short covering. Remember, the first candle is short covering. The second candle is when buyers start to come in. The third candle is when when more money starts pouring in and the hardcore shorts start covering, and then you have a little consolidation. And if the market really wants to go higher, it continues higher. It's just the way it works every single time. So this green candle that you saw yesterday, which was very powerful, was primarily short covering, period. Then the next one that develops is really where you get more confidence that there is real money coming in. Real money or not, markets went up big, all right? So you got to be prepared. Now, if somebody wants to wait a little bit and said, okay, I want to see what goes on, well, you got to be quick, all right? Because by the time the second candle's developing, there's going to be a third one coming. And once we break out of that, I just explained to you where we can go. That's it for now. Stay flexible. Do what you need to do. Vote. Exercise your right. This is the greatest nation in the world. And believe me when I tell you. Believe me when I tell you. Keep some of the harshness of the politics aside. Let's come together. Do it right at the Clueless Ape Trading Club. Thank you for listening. This is Frank.